Good morning, everybody. Welcome to the Flow Show. Here we go again. Another week begins. And we're going to see what big data is coming up and what we're going to get our teeth stuck into this week. Unfortunately, no Mr. K-Man today. He's suffering from the old dreaded lurgy, the old COVID doing the rounds, it seems. So he's unfortunately off sick today. We obviously wish him a speedy recovery. So just me, myself and I today to get you through this week's or today's Flow Show. Right, as you can see there, I just want to reiterate our big sale that we've got going on this week or going on this month. You can grab yourself up to 40% off an annual subscription. So it's never been a better time to get a good price, and obviously we lock in that price for you. So this isn't just a new customer offer where you take this price and then we bump it up when it comes to renewal time. As long as you subscribe, you will keep that price forever and ever, as long as you subscribe. So once you're in on a decent price, you can stay on that decent price for as long as you subscribe. Anyway, let's get cracking. I'm going to start with a bit of data. Over the weekend or overnight, we had China CPI data, which came in softer than expected, 0.6% versus 0.7% expected, though it was up on last month's 0.5%. Month-on-month inflation also coming in a bit softer than expected. PPI too coming in worse than expected. So still some disinflationary or deflationary price pressures over in China, and that will keep potential rate cuts on the table. So not quite ready to let off the hook rate cuts from over there or take their foot off the pedal for rate cuts over there. These numbers still very, very weak for an economy as big as China. And we did get some final numbers from Japan Q2 GDP, which no one is really that bothered about, considering we're pretty much close to ending Q3. So, but even so, that's GDP coming in a little worse quarter on quarter and year on year. So just a little bit of softening, but final numbers still showing positive growth. And that's the main thing compared to the first quarter. And that's something that will keep the Bank of Japan on their path. There was a bit of data out last week from the Eurozone. Well, I say a bit of data. Bloomberg put together some data from some Eurostat numbers for the Eurozone. They made it into a story that a key wage measure for the ECB came in softer. Now this number came in at 4.3%, down from 4.8%. Now they based that, don't ask me how, they based that on some Q1 data, or the first 3 months of the year, to produce this Q2 number. So I don't know if it's the official number or what, but being ECB week this week, the market will be looking for any signals that gives clues about future policy moves from the ECB. We are expecting them to cut rates at the meeting by 25 pips. That's probably not the important thing. The important thing is how they see the future for further rate cuts. Obviously, it's a staff projection meeting, forecast meeting, so they'll be basing all their potential future decisions on that. So that's going to be what's going to be important on Thursday. Right, coming over to more data and looking at last week's stuff. We got, we'll start with the Canada jobs data first before we get stuck into the NFP stuff. Employment over there, the net change was up 22,000, which was thereabouts expectations, turning around the loss from the prior month. On the Magic Roundabout, the part-time and full-time looked a bit more negative, with full-time employment dropping and part-time employment gaining. If you want to see a strong market, you want to see full-time employment doing much better than part-time employment. Obviously, if they're both positive, that's a double positive. But that drop in full-time employment not making the report look as good. Or as I say, it's a bit of a roundabout or revolving door, shall we say. These numbers can be up and down each month. The unemployment rate rose to 6.6%, but that was followed by the participation rate going up a pip as well. So that might have added something into that. So it doesn't necessarily make it a massively negative number, that unemployment rate rising. On the wages front, we saw wages coming in at 4.9%, down from the prior 5.2%. So still quite a hot number, but not as much as it was last month. So it's going the right way. As we know, the BOC are cutting anyway and are happy to continue doing so. So this data doesn't really move the needle on that at all. And now we come to the NFP, which it was built up to be a bit of a wild one, and it was a bit of a wild one in markets after the data, and really all over the shop. It got to the point in the afternoon when I just said, I've had enough. Market swinging one way, then swinging the other way, bit of a headless chicken moves in the end. So I just said, no, I've had enough. I'm not trading this anymore. It can go and do its thing, and I'll pick up the pieces today. So the number itself coming in at 142,000, which is not bad really. We were expecting 164, 165, so it was a bit of a miss. That prior month's number got revised down quite a chunk though, so that was a bit negative. Overall, not too bad. It could have been worse, and I think that's the main line to apply to this data. It could have been worse. We saw the unemployment rate coming in at 4.2% as expected. So if there were a lot of people looking for something worse again, they didn't get it. We got a drop down in the unemployment rate. Obviously, looking at the participation rate, they stayed unchanged as well, which makes that number all the more better, shall we say, rather than good, because it didn't affect that number at all. Wages, that came down, that went up, beat expectations, beat last month, went up to 3.8%. And the month-on-month number as well going up 0.4%. So overall, none of this data is 50 basis point cut data. And it was quite funny because the initial reaction in the dollar was to rally straight away on the number. We saw dollar yen. Let's go into it there. We saw a bit of a jump higher, then it just slammed down. Or it might have gone the other way. It was going so fast. And as you can see, we were up and down and up and down and up and down. So the market started pricing 50 basis points in the interim, and then it changed it right around. But I'll go over that in a moment, because not long after the data, we got some of the more bigwig Fed members speaking just before the blackout that started on Saturday. First, we had Fed's Williams coming out saying that the Fed is ready to start the process of rate cuts and that the jobs data is consistent with a cooling economy. Says we are moving in the right direction, but not there yet on 2% inflation. So while he's saying the jobs market is weakening, they're not quite there on inflation. He says lowering rates is about helping to keep the jobs market in balance. And then he came out with a line where he said he doesn't have a personal view on 25 pips versus 50 pips. Now, the doves in the market took that as meaning, well, that means 50 pips is on the table. So off they went again and sold the dollar, yields dropped, and the market got all dovish. He then followed up, said the Fed has no general principle on fast versus gradual moves. So the market was jinking around. And then later on, we got Fed's Waller, who doesn't speak often, but when he does, he can tend to move markets, or he does say something the markets pay attention to. And the first headlines, depending on what wires you read them for, sounded pretty dovish. He said the current batch of data requires action. He says, if appropriate, he will advocate for front-loading cuts. And then he said he is open-minded about the size and pace of cuts. Again, that got the market doves all happy and hitting yields and the dollar. He says it's important to start rate cuts at the next Fed meeting, but we must be nimble on policy as the data comes in, saying that forecasts could be wrong. He said, in a longer run view, 100k monthly jobs gain is normal. Now, going back to that line where he said, if appropriate, he will advocate for front-loading cuts. As I said, that was reported on one wires like that, but then another wire had a bit more detail, and he said that while it is appropriate and will advocate for front-loading cuts, he will do that in the same way that it was appropriate and had advocated for front-loading hikes. So pretty much saying that what he was happy to do on the hike side, he's happy to do on the cut side. So that took a bit of the dovish sting out of it. It wasn't as incendiary as those headlines first pertained. But anyway, as I said, rate moves went a bit bonkers. And I actually noted the timeline. So at 13:41, and this is London time, so that's what, 11 minutes after the NFP, traders priced in a 50-point rate cut for the Fed. Just over an hour later, hour and 5 minutes later, give or take, they reversed that back down to 25 pips. Then we got Walla, and at 16:05, they raced it up to pricing 50 basis point cuts in September. 4 minutes later, that reversed, and they went back down to pricing 25 pip cuts. All the while, the market is jumping up and down over this. Hence why I said, no, that's too messy for me. I'm not getting involved in that. I did have a trade over the NFP when the market was getting all dovish. I got in some dollar yen down in the 142.20s. Managed to ride that up to near 144, 143.80s. I think I got up to before all these comments came out and the market went the other way. So there was money to be made, but you had to be a bit quick about it, and you couldn't hang around taking profit either. But where do we finish? We finished down on the lows on Friday and coming into today. So that's where we came in, and so it looked like we might be having a bit of a continuation there. We couldn't get below. This was all the lows we got to in dollar yen last month when we had that, what the market took as a bad NFP report, an ISM jobs report. So the fact we couldn't quite get down to that low is pretty telling. It's become a big boundary now, and these sort of things you need to be keeping an eye on, because this tells you what the market wants to do. It was happy to keep selling the dollar, but it ran into something pretty tough down here. Ran into something a month ago, and it's run into it again. So this is now becoming a big old level down here. Call it 142s, 141.70s. Okay, so this is our marker now moving forward. Okay, we don't really know. We've got a rough idea where some of the highs are, but with the volatility that we've still got in play, we're still trading up 12.5% on the 1 month foals. We can still move up to 300 pips pretty quickly. But the fact we've come through 2 lots of data and what it means for the Fed, and we haven't cracked this level, makes it very important moving forward. So that's your boundary to the downside now. Break that, and we're probably heading lower, and maybe quite significantly. But we've got plenty of tech underneath it as well. So this morning, the dollar's looking a little bit better. Whether it's a dead cat bounce or not remains to be seen. I think right now the 50 pip cutters have been given a good kick up the arse and shoved out the market. So the market's taking it all together and saying, yeah, 25 pip cut is more likely from the Fed. Now what that's going to do is going to make any more price in the 50s potentially again a fade trade, because the market's going, no, the jobs market isn't collapsing. Even if CPI is a soft one, I still don't think we're going to properly price 50 basis points. I think we might get another reaction where the market goes that way again, but I don't think that will last. So that's how I'm potentially going to start off this week, with that view in mind. Again, any extremist pricing towards 50s, I'm going to look to potentially fade it. And obviously you've got that CPI on Wednesday. Right, while we've got it there, might as well have a little look and see what data we got coming up, because usually after the NFP week it gets a bit quiet, but we're in the tail end of the year and things tend to wind up a bit, get a bit busier. So tomorrow we have German CPI data. That's the final number from Germany. UK jobs report, that's going to be quite important. It's still a bit of a mess. Our bungling ONS still haven't got their abacus fixed, so we don't know what the data really is saying, but the market's going to move on whatever numbers it's given. Keep an eye on the wages data. As always, that's going to be the most important number there. On Wednesday, we get more UK data, GDP. This is just the monthly rolling number. We get some industrial production, manufacturing production data as well. So again, we've got the BOE next week. So all this data is going to have a bit more significance with that in mind. We do get UK CPI a day before the Bank of England next week. So that could be a bit of a big number, but that's for next week. And as I said, on Wednesday, we have US CPI. That's going to be the big data of the day. Expectations are for CPI to drop a bit to 2.6%. I've got from 2.9% is the number we're currently at. So a bit of a dip to 2.6%. Core number is expected to come in unchanged at 3.2%. But again, we'll look at that in more detail on Wednesday. Then Thursday, it's going to be the ECB. And as I said, not so much what they do with rates at the meeting. There's always room for a bit of a shock. But what the policy is going to be going forward. Are they going to cut again quickly, or are they going to sit on their hands until their next forecast in December? Jobless claims, we always keep half an eye on that one, not that it's showing much at the moment. But then we get PPI data, and it's back to normal this month, coming after the CPI rather than last month where it came before. So that might add or subtract something to whatever we've seen in the CPI data if there's a big variation. And then on Friday, we get not a lot. Final numbers from France, some import-export price data, and this will be the flash Michigan Consumer Sentiment Survey, so the first one of the month. And so we get a little look at what the consumer's up to ahead of the Fed, ahead of the FOMC next week. And obviously, we'll keep an eye on those interest rate expectations that we get from that data. So that's what we've got coming up there. Just give me 1 second. I'm just going to have a little look because I did invite a guest on and I just don't know, he didn't answer my WhatsApp until just now, so I don't know if he's here or not. So let me just see if he's here. Let me see if he's here. 2 seconds. No, he's not. 1 second, folks. Sorry, I'm trying to WhatsApp and run the show at the same time. Right. Okay, well, if he pops in, he pops in. Otherwise, I'll bring him on another day. So moving on, let's have a look at what is happening in prices. So, as mentioned, dollar yen. So we've got this very important support down here now. Keep an eye on that. Where we bounce to is anyone's guess. 144s at the moment is the main resistance point. Just on the short term, we have got this little level here, 143.40s, call it. Just when we had this move, then it bounced, we came down, found a bit of support there, knocked around it, just having trouble breaking through at the moment. So while it's a little bit quiet, that might be a bit of a sticky area. Otherwise, it's going to be 144s, 144s 20, then up into the 145 big figure. So there's a few levels you might want to just stick to, sort of mainly looking around the big figures at the moment, because that seems to be where we run into a bit of trouble mostly, or where we see the big traffic areas. Obviously 147, got up to 147.20s in that move at the beginning of last week before we saw this big collapse. So Dollar yen, it's going to really, if you want to get a picture of that, keep an eye on yields because it's pretty much a mirror image. Now, 2-year yields managed to break that prior low that we got in August. So that's a bit more of a significant move. It's just shown that the market is willing to push this a bit more, even though we've got a bounce and we're back above this sort of 360 level, which is a bit of a level. As you can see, we've got a bit of an area here, 350s, 360s. So the fact we're back above just makes that look like a little bit of a fake out for the moment. But this is the market. This is where the market's really playing the 25, 50 pip cuts. Okay, so you should always have yields on a chart somewhere just to keep an eye on, because this tells you this has been leading a lot last week of what's going on. So that's reflective in the yen pairs as well. 10 years, it looks a bit further down the line. Again, it also had a little bit of a shunt below that low that we got last month, but we've had a bit of a bounce. So this 370 area, we can test it, we can go below it, but for now we can't hold below it. And so that's going to keep your dollar from going too far as well. So while we're holding above that 370, the dollar's unlikely to continue going lower. What is likely, though, is that any decent rally we get in yields is going to continue to get hit. So people are going to come in and buy bonds. And as I mentioned a few times last week, that's really what the market was doing. You know, we saw the move in the dollar last week, but it was still doing it even around some of the data. And just for my mind, it meant that we weren't, the 25 and 50 pip rate trade that we're doing is all short-term stuff. The longer-term, bigger money is doing something different. It's getting into yield. It's buying bonds, either to make money on the price going up or to lock in higher yield because rates are coming down. So there was two forces at play, in my opinion, last week. And the bigger force was bigger money coming in and locking into yields, more so than the short-termers playing the 25, 50 pip game. The 25, 50 pip game was why we were seeing all that jumpiness over Friday's price action, up and down and up and down, and rate expectations changing that quickly. That's all short-term traders. Longer-term traders are doing something more. They're trending yields lower. They're trending the dollar lower. So keep that in the back of your mind, okay? You're potentially playing with two different markets at the moment. One playing the short-term data points, one playing something longer. Looking at the euro, that was looking a bit iffy this morning amid that dollar bid. We came down to pretty much down to support and hit it on the head. If we can get there, or hit it on the arse because it was coming down. So this support 110.40s down to those lows there, 25s, 30s, whatever it is, this little area here. We came down here this morning. We found a bounce off of there. Again, it's looking a bit dead cat at the moment, but in technical terms, the support level is holding, and that's all that really matters right now. So I think if we maintain above here, then we're going to keep in this 112 range down to this 110.5, 110.40 area, and run that either over the data or the ECB. So again, this has come through all the US data, all the Eurozone data, NFP reports, everything, and it's still sitting in this tight range. So for me, I'm just going to be planning maybe to trade a break either side of the range. I'm more inclined to trade a break through 112 because it's the bigger level. If we just come over to the daily, you can see how that 112 is a big old level. It goes back and back and back and back. Let's put it on my clean charts and you get a better idea there. So this 112 level, spoken about it often enough. That's why I wanted to short up there when we first tapped it. So I'm more inclined to trade a break above there than I would a break down through short-term support around that 110.40 area. I'll just zoom in again. Because if we do break below here, and this being the euro, unless it's being driven by big news, then we run into traffic down in the low 110s into the figure, down towards the 50 fib. So there's a bit more traffic to get a downside move, then perhaps there would be a break on an upside move. But, you know, whatever floats your boat. If you're looking to be short and you're not short now, then a break of this area is one area to be looking at. You know, get below and start to hold below this area, then you're probably going to get a shove a bit further down. But keep in mind, we're still in got two uptrends, if you like. We got the first phase here and we got the second phase here. So take it overall, we're still in this uptrend. So even if we do break lower here, you know, watch out your fibs. Your fibs will decide whether this trend is turning around. And you know, I can probably lob another one on there quickly. Oh, get in there. Mondays. I love Mondays. So the 38.2 of this whole move is down at 109.97. Okay, so that comes in pretty much around the 110 area. So we got a bit of confluence there. You got the 50 fib of this phase, and we got the 38.2 of this phase, all pretty close together and around a big figure that's had plenty of resistance before. So that's a big area. So if you get a break here, I'd expect it to run into trouble in around here. Okay. What else? What else? Let me just go back to the chat, see what anyone's going on about. Ali, who have I invited? I'm keeping it a secret. I'm keeping it a secret, mate, until he comes on. What did happen with you on Friday? I got knocked out the final part of my short from 112. I had my trailer at 111.30. That got knocked out in this move here. It wouldn't have mattered where I put it, either side of this line. It would have got knocked out. So I just put it at 111.30 because that's as much as I wanted to give back. So not a bad one. I got it. My last cut was 46, so just into that level there. So 10, 15 pips off the lows. Not going to complain about that. So I'm flat on that trade for now. I'm still short Euro Sterling, Ali. You cut your position. Yeah. It's grinding. It's grinding. I've got my stop on my shorts at 84.60. No, it's not. It's 84.65. I moved it up because we were talking about this 84.60 level last week. Just in there. So a bit of a level. So I had my stop bang on it. And as Mr. K-Man pointed out, it was a bit of a level. So now my stop is just above it because I don't want to put it bang on the level, find out it hits and then reverses down. The UK data this week could be a mover for you for this one, depending on what it is and what it means for Bank of England cuts. So if we get weak data, then this one is probably heading back higher. And obviously with the ECB in the mix too, it could be one that's all over the place at the moment. If I do get knocked out of that, then I'm probably just going to go neutral again, sit on my hands and look to continue to play the range. I may consider now trying longs down into the 84 handle, again with a stop reverse through 83.80s to go short on that one. Otherwise, we've got this middle area, 85s, 84.80s. That's really your pivot point for whether we're going to have a look at 86 or stay weak and carry on looking at 84s. Marcus, look at dollar Noki. Let's have a look at the old dollar Noki. What you got cooking in there, mate? Oh, a bit of a decent rally up in that one. Again, we're seeing a lot of dollar pairs doing the same thing. You know, this is one of those times where things like the other side of the currency pretty much takes a bit of a back seat. And it's all about what's going on with the Fed and the dollar, pretty much like it was when we had the hike cycle. You know, everything was about the dollar, not so much the other currencies. You're long at 66. Nice trade, mate. So where's this one going to go then? Let's zoom it out again. Not got a lot of techers on here, but always happy to draw some lines. So what we got going on up here? Not a lot to the top side. It's all a bit messy. If you want to take the wider ranges, the wider edges, then you're looking up here, 111.10s, 111.14s. this is a bit short term to put a fib on it. Let's stick one on anyway. Let's stick it from there. So it's already up through the 50 fib of this move. So you got the 61.8. I don't know if you've got targets or anything like that, Marcus, but you've got a decent bit of margin in here at the moment. You probably want to keep an eye on this area down here for any retracements, just those little highs there that we managed to break just in the short term. So if you're long, you don't want it to get back below there, and particularly the 70 figure as well. So nice grab, mate. Long at 66, you got plenty of margin. I want to see you running that as far as it can go, mate. Don't get out too early. You're in a winning trade. Try and run it as far as you can. You know, use trading stops. Bring your stops up behind it. I don't know how much. You probably need to give it a good 20 handles behind perhaps the current price. So, you know, if it's trading up here, 78, you know, you want to keep your trader. Well, you can probably put your trader at break even maybe or just above. But, yeah, play the range, upper line. Yeah, if you can run it up to there, fantastic trade, mate. But if you can do it, slice and dice. You know, take some. If you haven't already, you know, there's nothing wrong with taking a bit of profit off the table, reducing your risk, moving your stop up a little bit. You don't have to bring it all the way up to near the price, but just move that trade up, take that profit, and move your stop up. So, yeah, 1071. Don't know. It's right on that fib. And we got that level there. So it's up to you. I can't tell you how to trade, mate. But if it was me, I'd have my stop just below that. So maybe just below 1070. And if you get and hold above 1080, then maybe bring your stop up a little bit. It's all about just trying to, as the price steps up, you step your stop up. But respect the levels. Now, if you're going to respect these levels to trade against, you need to respect them to take profit against as well. Ali, what you got going on in gold, mate? Where have you popped that one? Let's have a look. Gold. Is gold going higher? I don't know. Is it going lower? At the moment, it can't do either. So really, this is where you don't need bias. And we've been talking about this for several weeks now. You don't need a bias for this one, okay? You can keep a long bias because the bigger picture, we're still in an uptrend. So you can keep a long bias to this one if that's what you want. But just for trading this range, all you need is if we break above there, chances are we're going much higher. If we break below there, chances are we're going to go much lower. So even if you're not in a trade, you know, you don't need to be, oh, I'm only going to buy it. Fine, buy it on support or buy a break. But if you get up here and it doesn't break through here, well, there's nothing wrong with trying to short then and just playing this range. That's all it's doing. It's walking in the range. So I don't know what I don't know whether it's expected to go higher or not. It's probably expected to go higher because everyone's long. So everyone's expecting to go higher. So what are you going to do if it doesn't go higher? That's the question you need to ask yourself, Ali. It's all right saying, I think it's going higher. The important question is, what if it doesn't? What am I going to do if it doesn't go higher? Or how can I profit if it doesn't go higher? So, as I said, it's pretty simple. Trade the range. We either break out here or we break out below there, or we trade between the goalposts. Right, let's see what else you're going on about. Good. Right, I don't know what else to have a look about, so we might just call that a show for today. As I said, I'm pretty in the mood now. I've not got much on. I've got a bit a cable short on, something we're just playing in our room today, and I got me short euro sterling. Apart from that, I'm a bit flat. So for me, it's just going to be looking around, looking at some of the ranges. You know, Aussie's looking like it's got a bit of a breakdown at the moment, but we've got a big level here, 66.5, 66.45.50. So if the price is going to do something there, have I got the wrong one? Oh, come on, you bugger, that one. what we got going in there. So look at that. It's amazing how tech works sometimes. So this is a big level on its own, 66.40.50, and it's also a 38.2 fib. So it's a bit of confluence there. I always love it when levels like that line up. I didn't even know it was there. See? So this one, decision time down here at that. If we hold here, it keeps the trend in play. Maybe we bounce, maybe we go on to new highs. You know where the resistance is. 68s, 68.20s. That's the big area. It's a bit like 112, 110 in euro dollar. Similar picture. Excuse me. Kiwi as well. Talking about this 62.14, this zone down here. Broke it. We had a bit of messing around. We've broken it. It's looking like it's starting to resist. So when that happens, you get more downside. How far it can go is anyone's question. So it's all about how much it can go after it starts breaking down. But all that does for the longer term, it just confirms this area is still pretty solid, even if we get some moves above it. We cannot stay above there for long. So on that note, you just trade the range. Try selling it up here. Hopefully you try buying it down there if you get it, or taking profit on the way. Right, Marcus, you like pound Kiwi? Blimey, pound Kiwi, mate. I'm gonna leave you to that one. I might answer you that one in the room while I have a look at it. I've probably even got a chart ready for that one. Right, we shall call it a day for today. I will try and maybe drum up my guest for tomorrow. No, Ali, if you're in early, as I said, Kay's got the lurgy, so hopefully that won't keep him out of things for too long. He should be back hopefully sometime this week. Right, have a good one, everybody. Have a great week. Trade safe, trade well, and we'll catch you all tomorrow.